Good morning.
Hey, who could this be? Hold on. Hi,
It's
Lori.
me.
How you doing? I'm just
I'm good. How are you? I'm ready
good.
for my private lesson.
Yeah, boy, you're getting your money's worth, huh?
Yeah, right?
Okay, I was just getting organized here. I think we're ready. We'll go through chapter 5 now, I believe, right? We did
Mhm.
4 last week. How'd you like the Super Bowl, huh?
Oh, you could not be talking to less of a sports fan.
Oh, really?
Yeah.
That means you know more than the betters. Believe me. Believe me. Just give me 1 second. I got to get my
Sure.
medicine. Okay, Lori, here we go. We're going to be talking in a moment about Chapter 5, adjusting journal entries. And allow me to bring the goodies up here.
Okay.
Share screen. Hopefully you see the first slide.
Yeah, sure do.
All right, we're off to a good start here. Go here. All right. Adjusting journal entries. Now, these can be a little bit tricky till you get the understanding of what we're doing and why we're doing it, okay?
Yeah, I read chapter 5. I skimmed over it and it kind of makes sense, but it feels like things are getting a little detailed and they're starting to get a little tricky.
Yeah, quite a little bit here. Adjusting journal entries are done by all companies. For the first 4 chapters, any journal entries we made, we always had a second company involved, right? A second party. We bought something from somebody, we sold something to another party, right? We paid our employees. Adjusting journal entries arise at the end of the month, Lori. When you run your trial balance on the 31st of the month, it is automatically incomplete and inaccurate because there are certain journal entries that can only be done after the month ends. And typically a company has maybe 3 days in the following month to backdate these adjusting journal entries into the prior month to get that month's financial statements up to snuff, okay?
Mhm.
And let's see what we can do here. We're going to prepare these things. End of period adjustments. Well, we have an adjustment journal entry that's pretty easy called depreciation expense. The reason I say it's easy, Lori, is that it's always the same debit and credit. It's always a debit to depreciation expense and a credit to accumulated depreciation, which is a contra asset account.
Mhm.
Assets have a debit balance. This outlier has a credit balance. And whenever you hear of a contra account, it is always married to somebody else. In this case, the accumulated depreciation is married to the equipment. Once you buy a piece of equipment, a car, a building or something, you are never going to credit that. Never credit it. It has to stay up there at that original number. But to recognize the tax wear and tear on it, Lori, you're allowed to debit depreciation expense, credit accumulated depreciation. So if you bought a car for $50,000 and you've had accumulated depreciation of say 20, the net book value is 30, the difference between the two. And that's what we're talking about, okay?
Mhm.
The prepaid insurance. When you buy supplies to be used in the future, or an insurance policy to be used in the future, those are assets until you do what with them, Lori?
Until you use them.
Exactly right. Until you use those supplies or you enjoyed insurance coverage. So you bought a $12,000 insurance policy on December 10th, but it goes into effect the following January 1st. If your business, God forbid, burned down on New Year's Eve, you're out of luck.
Right.
Next day, you're good. Okay. So what we're going to be doing is we're going to be using up that asset throughout the year by debiting the proper expense, which would be insurance expense, and reducing the asset. Here's one. We've all been out in the workforce. Employee earning wages. These have to be accrued the last week of the month. You know, you work at a job and you work from the 25th to the 31st of March, huh? Well, when you went home on that Friday, you didn't get a paycheck covering those hours yet because you're not going to get paid for 1 or possibly 2 or more weeks. But you worked those hours in March, say. You worked those hours in March. So the company has to record that expense in March, even though you're not going to pay anybody for a while. So you have to say that Lori worked 40 hours this week. She made $100 an hour. You know, it's $4,000. Whammo. That's salaries and wages expense, and the credit will be to an accrued account. Okay, and this is all about the matching principle. We've talked a lot about this in class. The matching principle, the principle that you must match revenues to expenses. If you didn't make these adjusting journal entries, and say the next month you shut the business down, possibly for maintenance, well, all of these expenses would fly into the next month, which would be incorrect. And you'd be showing losses for business that didn't even exist temporarily. Revenue recognition. That's what we're talking about, the matching principle. Revenues when earned. We think we know that now. Doesn't necessarily follow the cash. Revenues are earned when you ship the product or provide the service. Same thing with expenses when incurred. The month end comes and you're looking at the trial balance and you say, whoa, I don't see any electric expense, no utility expense. Well, you're not going to get the bill from Southern California Edison for another 25 days. You know, Bill Gates can't announce to the world, Microsoft is unable to announce the long-awaited earnings because we don't have the electric bill from San Jose. Obviously, you have to do something. You have to estimate that number. Yeah, estimate and record utilities expense. And expenses are considered incurred when they're received. And we're back to the matching principle, huh? By matching the expenses and revenues properly, you come up with a net income that truly reflects how the operation did. If you didn't match up properly, you're going to be handing out misleading statements, not only to the public, but to your own people, your own managers, your own ownership. So match those revenues and expenses. They love to be matched up. We know what a fiscal year is, right? Fiscal year could be any 12-month period that a business wants to look at. Doesn't need to be the same as a calendar year. And they have a little note here. I don't know about this being true, but I guess it is. Many businesses schedule a fiscal year end at a time where they're not so busy. Nordstrom's and Neiman Marcus and Target, big stores like that, they often have a closing on February 28th. They want to grab all those December sales and make a splash in the fourth quarter, and business is a little bit slower. They give customers a couple months to return things. Okay. Generally adjustments are made and financial statements are prepared at the end of a fiscal year. We know that's a bunch of baloney. It's done every month, right? You know the comedian Bob Newhart?
Sure.
He was a funny guy. He was an accountant in Chicago. That was his initial career. You may or may not know that, right?
I did not know that.
And he told a little silly thing by why he got out of accounting. He worked for a company that only closed once a year. And that was the only time the bosses ever they call him in. They say, Bob, how did we do this year? He said, well, we lost $9 million. They go, okay, Bob, we'll see you next year. He thought that was not a great career for him, Okay, now we're going to look at some T accounts to really punch this in. Supplies. When you see the word supplies in our book, it's really prepaid supplies. It's an asset. Supplies in our book means it's an asset. Supplies expense is what we call the expense, okay? So Mitch purchased $50 worth of supplies. Or rather $80, sorry. So there you go. That's not too tough. A debit to supplies and a credit to cash or whatever. And at the end of the month, he went out and he counted the supplies. There were only 20 left. Okay. This was 80, 80 bottles of cleaner or something. at the end of the month, they only had 20 bottles left. So how much did they consume?
$60.
Yeah, not that tough. $80 of supplies. If you didn't make this entry, assets would be overstated and the expense would be understated. You'd be telling the world you made $60 more than you did. This is a big company, it could be $60,000 worth of supplies. So look at our adjusting journal entry. We debit prepaid supplies expense. I am so sorry. I didn't say that right, did I? We debit supplies expense and credit prepaid supplies or supplies. So take a peek here. Hey, I'm zooming. See our journal entry? We debit supplies expense and we credit the prepaid account. And there's our journal entry, huh? Not too tough, I don't think. Same thing with prepaid insurance. This company bought an 8-month policy covering June through January. I don't know why they picked such a weird time frame, huh? June. So that's 8 months, 7 in the year before. During June, he paid $700 for a 10-month policy. Okay. Prepaid insurance was debited. The policy expires at the rate of, I guess, $100 every month. You see where that says 200 right here? What do you think? You think to me it should be 700? I think so.
Yeah.
It's a mistake. Not my slides. Easy for me to say. Adjustment for the expiration. Well, it was a 10-month policy lapsing at 1/10, $70 a month. So we debit the insurance expense and we credit the prepaid insurance for $70. Okay. There's where we debited the prepaid. And here we go again. Can you read those numbers? Want to make them a little bigger?
No, they're good.
Okay. As long as one of us can read them. Okay. Insurance expense debited, prepaid. And guess what we're going to do here, Lori? What are we going to do in the next month?
Adjust another 70?
Yeah, exactly. So this is going to go down to 630 and then 560, 490, etc. And the expense at the end of the year, adding up all the months, will be the 700. Okay. Adjusting journal entries. These drive the students crazy at first, but let's hope it's not going to be too much of a problem in our class. Here is the classic accrual. Rohan paid his part-time employees $16.27 on June 27. Means he gave out the paychecks that day. Obviously, that's for all the work done up until a certain amount of time, right? But since then, employees have earned an extra $400 from the 28th, 29th, and 30th, but they're not going to get paid for another 12, 15 days maybe. So that money that you earned, that $400, you worked on June 30th, that $400, you're going to get paid in July, but when did you work? In June. So we have to recognize wages expense and credit wages payable. Okay. All of these accrual entries, the book doesn't require that we do it, but any adjusting entry payable should begin with the word accrued by definition. Okay. I mean, if you put wages payable, that's okay, but it really should say accrued wages payable. An accrual, an accrued is a temporary payable. It's a payable. And here we go. So bring your attention to the wages expense. Remember, they already had the $16.50 going. Now they adjusted another 400. So at the end of the month, $2,050, and we owe $400 for you there. Okay.
Okay.
This is important. Historical cost principle. We'll get to some exceptions to this, but the rule is assets are recorded at their actual cost. Cost remains on the books forever. No adjustment is ever made for changes in the market value of an asset at this point. In other words, my great-grandfather, Jeremiah Smagula, back in 1900, he bought 20 acres of land here for $1,000 right on the beach. I still own that land. It's worth $1 billion today, okay? But it's still $100 on my balance sheet. We understand that?
Mm-hmm.
When can I show the profit on that land?
When you sell it?
Yes, exactly right, Lori. When you sell it. You cannot anticipate a gain. You must anticipate losses, okay? That's another accounting principle called conservatism. So, it's nice to have this thing here. I mean, I can go to a bank and they look at my balance sheet and they say, oh, you only have a crummy piece of land worth $100. And then I hand them a picture of the land and then they get the picture and, could loan me big money. Okay. An asset, a fixed asset, we're talking about a machine, a building, a car, a forklift, big computer system. They have in the world of accounting what's called a useful life. And companies are allowed to estimate the useful life of that asset. And theoretically, it's the result of wear and tear as it gradually goes down in value. The expense should be recognized and the value of the asset should be reduced over the useful life. Well, didn't we just say that we never changed the historical cost of the asset? That's still true. But we're going to recognize this deterioration of the asset's value, not by reducing the equipment, but we're going to debit depreciation expense and credit accumulated depreciation. What we're reducing, Lori, is the net book value every month. The original cost less the accumulated depreciation. So one of the favorite questions that pops up a lot on these tests is something like this. A company recorded an entry for depreciation. True or false? Did assets go up or down?
That's not a true or false question, but assets would not change.
No, they certainly would, because you debit. Maybe I can say clearly. You record an entry to record depreciation expense. You debit depreciation expense and you credit accumulated depreciation. Assets go up or down in that case.
They would go down. Yeah.
Because accumulated depreciation is at contra.
Right.
Contra to. Okay. So if you look at any company's balance sheet, you're going to see that there all the time. You're going to see Exxon Company and you get to their stuff and it says oil building in Dallas, $1 million less accumulated depreciation, net book value. Depreciation, a method of matching the cost against what it's doing for us as time goes on. And right now we're only going to look at one kind of depreciation, straight line, and understand that depreciation expense is an estimate, not a hard and fast number. It's an estimate. Depreciation expense based on the estimates of the useful life and salvage values.
So that does a question about those. Are there guidelines for companies to use, or is that just an arbitrary number? Can they just decide?
Great question. That's where I was going. There are some rules. They're pretty loose, but there are rules. Companies have to follow another accounting principle called systematic and rational. Okay. For example, you buy a big machine for $500,000. Okay. Well, that machine obviously is going to last a while. But if the boss comes to you in accounting, Lori, and he said, Lori, do me a favor, let's just depreciate the whole $500,000 this month, and then we'll generate a huge loss and thus save taxes. And then next month we'll bounce back and look good. Could you do that? No. Has to be systematic and rational. And there are guidelines from the IRS. Okay. For example, computer equipment, that doesn't last very long, does it? I mean, computer technology changes all the time. You buy the best laptop on the market today. In 3 years, they'll be a lot more better than that. So the life of a laptop might be just 3 years, maybe, for depreciation purposes. Okay. Companies love depreciation expense. How come, Lori? They love it. The more, the better.
Well, it makes their profits look better, right? Or
Makes it look worse.
oh, right. Okay.
And why do they like depreciation expense? Because it doesn't involve something called cash.
Right.
In other words, you have one company had a profit of $1 million before they're adjusting journal entries, and the other one had $1 million. But the first company had $300,000 of depreciation expense to adjust. That reduced their income to $700,000.
Right.
And at 30%, they saved maybe $1 million or whatever in taxes. The other guy had no depreciation. So companies love depreciation. They love amortization and depletion. Okay. Now, here's an important thing to understand. Salvage value. Salvage value. Okay. It's simply an estimate at what you think this equipment or machine might be worth at the end of its useful life. It's called salvage value. Residual value is what we call it in 230 for some reason, residual value, but scrap value. Okay. You bought a car for your sales manager, and he puts a lot of mileage on that car. He drives, 40,000 miles a year, and the estimated life on that car was, say, 6 years. And 6 years later, he's driven that thing almost $300,000. Okay. Right up front, we can say maybe the scrap value on that car is going to be only $500, meaning a junkyard might come in and tow it away for $500, that type of thing. Okay. But the important thing to remember with salvage value as well, Lori, is you don't depreciate that part of the asset. So if you bought a machine for $12,000 and you're going to depreciate over 10 years and the salvage value was, say, $2,000, you would have to subtract the 2 from the 12, and the 10,000 is called the depreciable base, the depreciable amount.
Okay.
And I'm getting a little bit ahead of us. This is more of a 230 thing, I guess, but I think we have it here. You can never, ever bring the book value, the net book value of an asset below the salvage value. And that's going to come in handy later, okay? So that machine, we paid 12. We're only depreciating at 10 over 5 years. At the end of 5 years, the full machine is now depreciated, 10,000.
Okay.
Hopefully someone will give us $2,000 for it. If not, we might have another problem, okay? Straight line depreciation. This is pretty clear, I think, if you've gone through the chapter, huh? All we're going to do is take the cost of the asset and divide it by the years. And that becomes the annual depreciation. So I'm looking at an asset for $4,800. Salvage value is 0, so there's nothing to subtract. And they're going to be doing this every month, like good companies do. So what they're saying here is $4,800 divided by 60 months is how much? Oops, sorry. $80 a month, right, Lori?
Right. So that then is assuming that at the end of that time that the scooters are worth nothing.
Right. Right. Okay. Whatever this thing is here.
Okay.
So depreciable cost. That doesn't mean they can't sell it. Somebody might come in and say, I'll give you $1,000 for it. That'd be great. I worked for a company. The job I had the most was about 15 years down in LA. And we had a little printing operation in the corner of the factory. And we had an old lead type machine. It melted lead. And it dropped melted lead into the molds. And then you'd roll the paper over it. And a long time ago, before the the computers and the graphic arts, we used that machine fairly regularly for Hollywood. We were good at making wanted posters. You know what I mean? Things like that. But here's the point I'm driving to. That machine was depreciated fully back in the 1930s, believe it or not. And we still had it all those years. So you never know. Okay, so what's our journal entry? We're going to debit depreciation expense and credit accumulated. Here we go. Net book value or book value, the original cost minus the accumulated depreciation. Accumulated depreciation is an asset. It's a contra asset. And you could also call it the amount that's undepreciated. Okay, the net book value is undepreciated yet. And we understand that the net book value of an asset has absolutely no relationship to what it's really worth in the marketplace. And that's important to understand. Like with that land that I'm sitting on here down on the beach, it's still $100 on my company. Okay. And that's important. It's an estimate. And that whatever that price is, that the value of that asset is, that net book value has nothing to do with, I don't want to say reality. It has a real effect in our statements, but it's not going to drive any market price. Accumulated depreciation is a contra asset account. It is from the Spanish word contra, which in English means contra, means the opposite, right? Contra, it has the opposite balance. So it's got a credit balance, and whatever that balance is going to be deducted from the original cost of the asset. And the journal entry is always the same. You get a problem on the test and it has depreciation, you don't have to think, well, I know I debit depreciation expense and I know I credit accumulated depreciation. And typically you'll have accumulated depreciation dash perhaps a category of your fixed assets. You won't have one account for every asset, obviously, but you'll have one accumulated depreciation dash vehicles, dash buildings, okay, dash equipment. And here we're looking at it, huh? Depreciation expense is 80. The accumulated depreciation is now 80. It's apparently the first month that they're depreciating. So the net book value now of these two guys, $40,720, okay? Pretty good with that, lawyer?
So far.
Yeah. And all they're doing here is putting in red, I think, new accounts maybe you've not seen before. So in this chapter, they introduced accumulated depreciation, wages payable, okay, supplies expense. We had supplies in prior chapters, but not the expense. And now we have insurance expense and depreciation expense dash, okay? Expanded chart of accounts. Post these entries to the ledger. Well, let's go through them now. Here I see a debit to supplies expense. Remember, we bought $80 and we counted 20. Okay, so we got a debit supplies expense. And what are we going to credit? Let me make this bigger because I can't see it.
Yeah.
You see it now, right?
Yep.
Looks like they're showing all of these things. Okay, hold on. Okay, here we go. Yeah, where's the supplies? That's the one we were looking at, right? Supplies, what are they doing to me here? Anything to make me look like an idiot, huh? Okay. Let me do this. That's fine. We work around that very easily here. Oh, here it is here. I went too far. Zoom. Okay, there's our journal entry, okay? And take a look at the two accounts involved. Here's your general ledger. General ledger. And remember, the general ledger is a fancy pair of T accounts, right? In appearance. One T account for the transaction, one T account for the balance. So we bought this stuff in June 16th. At the end of the month, we recognized we used 60. We now have a balance of 20. And the resulting expense is 60. Okay.
Mhm.
Same thing with insurance. What they're showing you on this page are the two of the many prepaids, okay? Again, you bought prepaid insurance, which lapsed to the tune of $70. We debit insurance expense, bringing the balance to 70. And now the balance after the 700 has been used up 1/10 is 630. Okay. And here they're showing a couple other examples of our journal entries. Here you go, wages expense. That's the $400 somebody worked on the last day of the month. It belongs in that day, in that month of June, even though he's not getting paid till the 15th of July. So there's our journal entry. We debit the expense, we credit the payable expense. Oops, I'm sorry, I'm moving this all around here. Fine. Debit the expense, credit the payable. And I don't think we have a problem with accumulated depreciation. Or it's funny how this thing doesn't want to move. Okay. Yeah, take a look at that entry there. Debit the depreciation expense and credit the accumulated depreciation. Okay. The depreciation expense is just going to be that one number every month, right? It's not a cumulative number. It just gets every month, whammo, and then we zero it out, as we learned in chapter 3 or 4. Okay. But the accumulated depreciation number, that's going to rise until you reach the original cost of the asset or the amount that you are depreciating less salvage value, okay? See here? Prepare a worksheet, okay? So every company in the world does this. The smallest mom and pop store, assuming they want to have good financial records, they're going to print out a trial balance, okay? As soon as the month ends, whammo, you print out a trial balance. And all that trial balance does, Lori, is tell us that debits equal credits, right? That's all it does. Every number could be wrong, but that's part of the closing process to go over it. So we come up with the worksheet, and once we get that preliminary, what I like to call the preliminary trial balance, we're going to prepare our adjusting entries on that worksheet, and then bring over the new balances. And now we have a finished, correct, final trial balance. So the worksheet, that's where we enter these entries on paper, prepare the statements, and the worksheet is just that. It's a worksheet. It's just a piece of scrap paper, usually prepared as an Excel spreadsheet, which certainly can be, not a formal report. Only the accounting people do this. Nobody has ever looked at General Motors financial statements and demanded to see the worksheet. They just want to see the finished product. Okay. And we're talking a 10-column presentation. And I'll take us through this a little bit. These are the steps. And once you see it, this will come, I think, a lot easier. What do we do at the end of the month? We prepare the trial balance. We know how to do that. Once we prepare the adjusting journal entries, then we're going to take that beginning trial balance and we're going to go debit or credit and get the new balance. Once that is blessed, we have what we need to prepare the income statement and the balance sheet. And that's what we're going to put in the in columns 7 through 10, complete the worksheet. So I hope they give us a good example of the worksheet, huh?
Yeah.
If not, I got plenty I can bring up. Anyway, worksheet, your company, blah, blah, blah. Prepare the trial balance. So here they're saying what we're going to see, I guess, on the next slide is the same trial balance from chapter 3 on a 10-column worksheet. Okay, we're going to get there in a couple more slides, okay? Bear with me, okay? Prepare the trial balance. Write the heading, account titles, debit or credit. Place a single rule across the trial balance columns. I don't know about the rule or the double rule, but those are, no, that's pretty normal, huh? Debits must equal credits. That's the key thing. Now, we look at every single thing on that trial balance, and maybe it requires adjustment. Maybe you see an obvious error. You might notice that, for example, accounts receivable has a credit balance. That's not possible. So you would, do some research on that. You could call that an adjusting entry. It's more of a correcting entry. So you prepare your adjustments. So let me beef this up here. I'm sure you can read all those numbers, huh? Okay. You can read everything, Lori?
Yeah, that looks good.
Yeah, so let me take a snort here. People have been telling me for 50 years I drink too much soda, right?
Mm-hmm.
And one friend of mine one time, he brought in 2 glasses, right, Lori? And he had a worm with him. And he filled one glass up with my soda and the other with water, right, Lori? And he took the worm and he put it in the water, and the worm was happy and swimming. He then took the worm and put it in my soda, and the worm shriveled up and died immediately. My friend said, "What does this tell you, Bob?" I said, "It tells me if I keep drinking soda, I won't get worms." So that's what, just remember that. Silly joke. Anyway. So what do we have here? Our worksheet for the month ended. Cash, 470, right?
Mm-hmm.
You will never have an adjusting entry with the word cash in it. And students make that mistake. A lot of students, when they get confused, they'll throw cash down. Cash is never. You don't go back to the vault at the end of the month, Lori. And I send you out to the vault. Count the cash, Lori. And you go back there and you say, "Well, Bob, there's $46,000 there." And I look and I say, "Well, our records say 47,000. Okay, we'll adjust it." You don't adjust cash, okay? You're never going to touch accounts receivable, but supplies. Here we go. Supplies. What's the journal entry? We're going to credit the supplies account. And what do we debit?
Supplies expense.
Okay. Look at B, prepaid insurance. Insurance expense, debit 70. Insurance expense, debit 70. Credit the asset. What else do we have here? Well, we had to accrue $400 of salaries, right? Salaries expense, work the last day of the month. And we're going to credit wages payable. So that gives you the right expense for the month. But just remember that payable is also correct, because the company owes you the money that day. When you went home on June 30th that day, they owed you the money. You can go to them if you quit, they have to pay you. If they fire you, they have to pay you. If they go out of business, etc. It's the only reason they're paying you 2 weeks late is when you join the company. They said, "That's our policy, take it or leave it." Okay. So the liability side is just as important. So here we go. We have a trial balance that adds up and balances. And guess what? The adjustments have to equal too, okay? So at this point, Lori, we've done the hard part with this thing. We've done the hard part. We've come up with the adjusting journal entries. Now we got to do the adjusted journal entries. And that's going to just mean taking those first 2 columns, the trial balance, plus or minus the debits and credits.
Okay.
So preparing the adjusted trial balance, extend those debits and credits that are not adjusted directly, enter the adjusted balance. If an account has a debit and a credit, well, obviously got to take the difference. 2 debits, you say add them. I think we know that. And then I'm not going to worry about the ruling. They're assuming we're doing it in pencil for some reason. And guess what? Debits still need to equal credits, okay?
Mhm.
And by the way, this is a job I used to like to do in the old days when it was done in pencil. Come on, come on, come on, come on. Oops. I want to blow this thing up a little bit. Okay, so here we go. And when you're doing your homework, you guys, everybody in the class, look at this thing, because this is what you're going to need to understand on the test. You're not going to have to prepare this, but you're going to have to know what to do with it. So let's take a peek here. Cash and accounts receivable. Well, they'll never be adjusted. So you just bring the number over. Prepaid insurance was 700. We chewed up 700 worth of the asset, 630. Accumulated depreciation, we had none because we bought this machine in this month. This was the first month.
Mhm.
So we bought a machine for 4,800. And if you remember, we're depreciating it at the rate of $80 a month. The original cost of the equipment is never going to change. What's going to change is the net book value, the marriage between the contra and the father asset, I guess we'll call it. Accounts payable, you're never going to adjust that. Wages payable, oh yeah, that's a basic one, huh? You notice there's no wages payable there? And that's true. I'm so sorry. At the end of the month, those accruals get reversed. Sorry about that. I gotta take my hands off it a little bit. Okay. Capital drawing. Well, you don't have any adjustments there. And then you have your revenues, delivery fees, and then the expenses. You notice, of course, that it goes in the proper order.
Mhm.
The accounting equation: assets, liabilities, equity, revenue, expenses, okay? And I'm going to give you a tip, and others in the class. You see where it says delivery fees there?
Mhm.
Draw a horizontal line above that. Why did I tell you to do that? Because everything below that line is your income statement and everything above is your balance sheet. Unless they're real jerks and they don't give it to you in the proper order. But that's not going to happen in this class. Okay?
Mhm.
So we brought over all our information and now we're in balance. And right away, if you wanted to look quick, if the boss came out and said, how do we do this month, Lori? And you would say, hey, come on, boss, I haven't even done the financial statements yet. But I can tell you right now, we had sales about 8 minus 2. Yeah, we made pretty good money. I just don't know the exact number yet, okay? Sales minus expenses. So now we go to the next step. Extend the adjusted balances to the income statement and the balance sheet. This means we're just going to copy from columns 5 and 6 the income statement items to the income statement column. And then we'll do the same thing with the last 2 columns, the balance sheet. I'm going to skip this because I think I can present it in a very clear way, and then I can go back to it if we want to. Okay. So take a peek here. Now it gets interesting, huh?
Mhm.
Remember what I said? Everything after drawing, if you will, or starting with your first revenue, 8,000, that adds up to 8,000, right?
Mhm.
Your expenses added up to 3,360, right?
Mhm.
Well, drag that way over. Come here. I just wanted to go to here. Net income, 4,460. These 2 columns are out of balance. We want them to be out of balance at this point. We would love to see a gigantic number on the credit side. So this company made a profit of 4640.
Mhm.
Okay. So we are going to add that 4640 to the 3360 to balance these two columns. Okay.
Okay.
Now we go over to the balance sheet. We bring everything over and we're at a balance. And if we did the sheet properly, we're going to be at a balance by the same exact amount. That's what we want. So let's see what we have here. Our capital is going to go up by the net income, right?
Mhm.
So we had X amount of dollars value in the, now it's going up by the amount of the net profit. And that's kind of your worksheet. The worksheet. Okay. It's an invaluable tool. And like they say, that you're probably going to be doing this in Excel or QuickBooks or something like that. Okay. A lot of software, they'll have a link to Excel to do these things. And
Mhm.
you do them in Excel and then you tell it to download back into your own stuff. Okay. Any kinds of questions so far, Lori?
No, I mean, it's a little confusing, but I think doing the homework will help clear some things up.
Okay. Yeah, the hard part is doing the journal entries.
Mhm.
What are we trying to do? And adjusting journal entries and adjusting journal entry is pretty much a search for unrecorded expenses.
Mhm.
Let me say it that way. Okay. That's what it is. Expenses we can't possibly do till month end. Now we could do it, right? We could do it every day, but that would be stupidly wasteful of time, right?
Mhm.
I mean, do we want to send you out to count the supplies every single day? And you come back, we use 5 pencils, Bob. Okay, that's $1. It's, you wait
Right.
till the end of the month. Same thing with depreciation expense. Yeah, you bought a machine today, but who's to say you're not going to bring something else in before the end of the month? Okay. So the worksheet. Here we go. Talking about finding errors. Don't make errors, right?
Right.
This here, well, I'll just talk about this for just a moment here. Certain things, check the addition, check your numbers, make sure you put it in, blah, blah, blah. Make sure the net income has been added. Obviously, all they're saying here is review your work, right?
Right.
Journalize adjusting entries from the worksheet. You know about transposition errors, right? Did we talk about that at all? How can you tell it's a transposition error? Do you remember that?
Divisible by 9.
Yeah, the difference is always divisible by 9. And one student a couple of years ago at the school here, she said, "Why are you even telling us this? We're going to be doing this on computers." And I said, "Well, it's good to know." And I said, "And you're belittling the fact that I used it for millions of years before we had computers. So shut up." No, I didn't say that. Journalizing adjusting entries. The worksheet helps the accounting organized. When you put stuff on the worksheet, all they're saying here, Lori, well, that's fine, but you got to journalize them in your general ledger. So here we go. I'll make it a little bigger. Zoom. Zero. Okay. See, we're just looking at a part of our worksheet, right?
Mhm.
Here's your adjusting journal entry columns. Now, once this is complete, now we have to take a moment and do the journal entries. Do the journal entries right here. And there they are, huh?
Mhm.
And they're giving you a nice color reference. And notice what I said before. At this level of accounting in 110, an adjusting entry is a search for unrecorded expenses. Debit, expense, expense, expense. Okay.
Mhm.
Explain the cash, modified cash, and accrual basis of business. No, we're not going to teach that. We're not going anywhere near cash method of accounting. Okay. And the reason is it's not GAAP. It does not give you any accurate financial statements at all. If you run your business on a cash basis, and QuickBooks lets you do that, actually, you'll cash basis yourself out of business before you know it. If you're using a cash basis, you're not going to be able to borrow money. You're not going to be able to attract investors. No one's going to trust your statements, okay? Just let me tell you what cash basis is. Cash is king. Whenever cash is spent, that's when you record the expenses and revenues. You sold me something in July for $1 million. I paid you in September. September would be when you would record that income. So the only business I know that runs on a cash basis is my brother-in-law back in New Jersey, who lives in my house that I purchased with my sister. And he and his family own a bunch of like garages and auto parts stores. And I was kidding him a couple of times. I said, Artie, how much money you make there? He says, well, he said, it depends. I said, what does it depend on? He said, well, at the end of the week, whatever's in the cash register. They never have to borrow money. You know what I mean? So they can get away with it. Accrual basis. Let's talk about the accrual basis. We've talked a lot about this, but it's so important. Revenues recorded when earned. When you delivered that pizza. When that customer picked up the product. When you shipped the product, okay? Expenses are recorded when incurred. That $400 you worked at the end of the month. We incurred it then. Belongs in that month. Recognizes revenues and payables. Accrual basis of accounting offers the best matching revenue to expenses, the best method of measuring income. Smaller places, yeah, they can use it because they're not interested in going to a bank and borrowing money. They're not trying to get listed on a stock exchange. They're not looking to grow the business. You know, they just have their little niche and they're happy with it. And that's pretty much it, huh?
Okay.
I don't think we're going to go into the other depreciation methods. I'm going to speak with my boss on that. I kind of hope we do, because I think it's kind of interesting, different ways to depreciate. So I guess that was it for this chapter. Do you have any questions on this thing, Lori?
I don't think I do, but let me dig in and I might have some. I might check in with the tutoring if I need some help.
Okay. I'll give you a tip. I don't tutor today, but I set up a meeting with a couple of students in different classes. You can join me at 5 o'clock today if you want. But
Okay.
All right. So I guess we'll let you go, huh?
Okay, perfect.
All right. We'll see you later. Okay.
See you next week. Bye.
Bye-bye.